Google, Bill Bodner, former golf pro. He's been in the music industry. If you've ever seen Rock of Ages, he was part of the group behind that. So really fascinating guy. But I know him as a mortgage and a markets guy. And as you remember, when 2019 was wrapping up, what were we heading into? 2020. And not going to go into details, but he was one of the few people I remember when he was doing market analysis towards the end of 2019 and had laid out forecasting what's going to happen. And then kind of at the end, he had, but there's something on the horizon happening in China. There's this thing called Corona, this potential virus. And if that gets over here, that could change everything in our mortgage industry. So he doesn't get really credit on the national scene about this, but he was one of the first people that actually laid that out and anticipated that if what happened in 2020 did happen, and he's talking about this in 2019, it would be a disruptor and would really change things in the mortgage industry. And we all know exactly what happened. So what I love about being around him is he's got the heart of a teacher.
My name is Bill Bodner, and I have my bride here, Karen, with me. We have a software company called Tabrasa. Rather than your typical economic talk with high, technical jargon, you try to make it relatable, right? What's happening? Where are rates headed? Why are they headed that way? What's next? So that your loan officers, as we go through this discussion, think about what it would be like for your loan officers, just be a little bit better, be able to talk to this stuff, whether you're talking to a member, an opportunity, a realtor, the government reopen, what does it mean? So that's what we're going to talk about, and it gives your loan officers the ability to speak in real time, right? And rates were spiking, and to his credit, he did a great job, right? He started staking the ground, he stabilized the market. He didn't do this, right, buy bonds to help, fuel a refinance bonanza and a purchase business craziness. But he did a great job, stabilizing the market, but he did it too long. And that was his first error. Right? He did current events with my friends at Arch, and I said, I'm going to tell you one thing that's not going to happen between now and next year. Prices are not going to rise by 6.5%. And so they're not, and like I said a moment ago, things change fast. As you can see, consumer confidence rebounds on lower inflation. This wasn't like 40 years later, this was like weeks later. So don't get caught up on the consumer sentiment. Give your clients a hug, give your members a hug. We obviously don't want the soft data to become hard data where you can measure and say, oh crap, now we're really hitting the wall. This is a pretty neat chart because not all inflation is created strike zone, right, to use a baseball term. But it's not all equal, right? I don't know if I could buy this screen, but if you buy a television set, you can see here, if you wait 6 months, you get it half off and a host of features. But the inflation that makes everybody in this room and everybody around the country go crazy are the 3 H's. Housing, healthcare, higher education. Healthcare, housing, higher education are government subsidized. Look at this kerfuffle that we had in Washington, D.C. What was it about? It wasn't about lowering healthcare. It was creating a subsidy just so that we can make the inflationary impact feel better. Call it what it is. It was a subsidy to help offset the ridiculous rates of inflation. Maybe we should get out of the subsidy game, because maybe subsidies are what are creating the frenzy. Kind of like low interest rates had the wrestling matches in the driveway, something similar. So it's a tough nut, and you can see these rates of inflation, 256%. Hospital services, that's running 3 times overall inflation. So it's not running at 2.5, it's at 7.5, 8%. Completely unsustainable. But there's good news. I told you I'm very, very optimistic. And this is, again, not something media's not going to be your friend here, right? So the last CPI number, they took the furloughed workers to come out and produce the September CPI reading. Now, when you look at inflation, housing makes up an outsized portion. When you look at CPI, it's upwards of 40%. When you look at core PCE, the Fed's favorite gauge, it's 18%. So it's a big number. If housing comes down, inflation comes down. Well, the good news I'm here to share with you is the last reading, it came down. And how did it come down? Owner's equivalent rent rose 1/10 in September. It was the lowest reading in 5 years. That means they go and they kind of look at what people think they can rent their home for. It's been unusually high for the longest time, and it's been a headwind for inflation to come down, and it's probably the #1 reason why the Fed hasn't been able to cut more aggressively.
Okay, so let me kind of tell you who we are at First Close. First Close, what we do is we have about 220 clients, and what we do with our 220 clients, about 90-ish are all credit unions. So we specialize in the credit union space. And what we do is we help you get your members off the street very quickly on your equity loans. What does that really mean? Well, within our POS, and I'm going to show you a couple screenshots in just a second. In our POS, what we do is when your member goes online and applies, we start technology behind. They put their name, they put their address in. Immediately, ABM is pulled behind the scenes. A question will come up and say, hey, we want to pull a soft credit. It's not going to affect your credit score. If you agree, click here. It immediately pulls a soft credit. And then all of a sudden, based on the findings from the ABM, we reverse engineer it. So we know when they bought the property, we know how much they took the loan out for, we know how long they've had it, so we can re-engineer what's their approximate balance on their house versus the ABM over here, so we know what lendable equity they have. We match that with your parameters internally, and then it'll spit out an offering very quickly for them. So that's in a nutshell kind of what we do, but we even do it a lot quicker and better than a lot of other systems, and I'll tell you why. Is because we put automation behind it. So as soon as that borrower accepts your terms, all the services are ordered in the background, and they come back very quickly. We know that 25% of the mortgages across America are over the 5%, right? So that means 75% of all the mortgages, as he talked about earlier, they're low rates. People aren't touching those right now. Regardless of what you saw there before, we know that for equity. So you have a lot of members out there that have a lot of lendable equity out there. And the mortgage site continues to struggle, keeping those volumes up, right? So let's talk about the consumer's expectation. What is your member's expectation? Well, if you're like me, I may be older in our business, but I'm still technology savvy. Do I have to ask my son, hey, how do I do this on my phone? No, not usually. But I can tell you your members are more sophisticated. They want instant gratification. If they go on your site and you have a mortgage application for a HELOC or a HELoan out there, and it says somebody will get back to you within 24 hours, they're already on another website going, hey, I don't want to do this, I don't want to do this. So what we do is we're going to get your borrower or your member off the street in 10 minutes or less with our whole cascading technology there. So I'm going to show you the digital application real quick, the borrower portal or order management solutions, and the digital close, because we do all of those. On a line of credit, you can qualify for this. Maybe you guys have a minimum draw amount. It'll come out there and it'll report, and it'll give you the price on there. Well, I don't really want an equity line. I want an equity loan. They can toggle between the two, and it'll give it. Well, let's say, for instance, they're eligible for $210,000. Maybe they want to do $100,000. Well, as soon as they would change that in there, your pricing is going to refresh, and it's going to change their pricing. They're going to be able to select what product they want with you that fast and that easy. So remember, this is done in the first 90 seconds. All this comes up within the first 90 seconds. Then, all of a sudden, they get another screen. Hey, by the way, here's your debts from your credit report. Do you want to do any debt consol? So they may say, oh, I wanted $30,000, even though there's $100,000. Wait a minute, maybe if I paid off some of this stuff, I lower my debt to income, right? They'll get that alert. And then, the application comes out. But in the borrower portal, immediately you can set up defaults in here. Hey, we're automatically going to need your proof of insurance, homeowner's insurance. We're going to want to know, hey, where do you want the funds deposited, what account? Or maybe you want to put on here a copy of your note, 2 pay stubs, or whatever you want to put. You can always add, but you can default certain things to your member very quick, very easy. Right, here's what they ask, but it's pretty quick. Well, what's happened on the backside? This happens to be a Meridian Link customer of ours. So what happened is that all went through immediately. As soon as they put their name and their address, it created an account in the consumer Meridian Link, or in Encompass, or in Temenos, those types of things, right? So this is what you guys see on the backside. It's showing, hey, all the services have been ordered and they've been completed already. Right. So there's a mortgage maker, there's that rocket, You know, they're going after those. Loan Depot's going after your customer. They pull those same reports that he was showing you where you can do the equity and stuff. They know who the people are. They'll go for certain area and they'll start marketing these people saying, hey, so the time is now to get your borrowers off the street. So at first close, that's what we do. That's the kind of things. So it was a very short little presentation I had here. She told me I only had 10 minutes, so here we go. Any questions? Perfect. Well, thanks for having me.
Authors can tell you, and as Anthropic can tell you, into tunes of billions of dollars. OpenAI will probably tell you for tunes of billions of dollars. Once an AI is trained on text, it can and it will regurgitate it explicitly. I guarantee you there will be a future where you will be able to do corporate espionage just by going on ChatGPT and trying to get it to leak data that had been inadvertently trained on. Because AI is a fantastic fraud enabler. Generative AI can be used multimodally to create fraudulent, what we call phishing attacks, of the sort that we've never seen before. Now I'll give you an idea of what scale means. When I say that AI can scale fraud, let me give you an idea of what human scale fraud looks like. A few months ago, the Secret Service found in the New York City area several SMS server farms that were being used to proxy largely fraud-related SMS traffic, right? I don't know about you, I get probably 2 or 3 spam SMSs a day from some offshore number or some onshore number with suspicious requests. Those SIM racks collectively can send 3 million SMS text messages per minute. That's how big the global demand is for just SMS fraud. That's the human scale. Now when I say AI can scale that to an order of magnitude more, that should give you an idea of how commonplace this is going to be. Also, humans can only sort of become a believable fraudster at the speed of reading. Now, we've seen for the past 15 years now, we've seen that global fraudsters have a remarkable ability to get inside your organization using external tools. They'll go into LinkedIn, they'll go into social media, they'll pull D&B data. They will create, it's exactly the same sort of thing that a company selling to you would do. They can create power maps, personality maps. They treat it just like a sales effort. They know who's in your organization, and they know where the weak links are. They're extremely good at mapping that. It takes time, it takes effort. It takes hundreds of thousands or millions of people doing it. But humans have done it for years. AI can do it in seconds. Worse yet, if they have your voice, if they have your video, if they have your photo, generative AI can work multimodally. In real time, they can generate speech that clones your speech. In near real time, and it's approaching real time, they can create video of varying quality. We're seeing that put more stock in things that they can touch, they can feel, things that we know are not automatically generated, right? We can't do that. That's gone with text, that's gone with photos, that's gone with video. What does that look like societally? We're going to see more of that. Likewise, when you think about fraudsters, you have to recognize that traditional electronic channels of communication are irrevocably compromised. This is where I'm giving Ken his due here, since we're in communicative cybersecurity. But it is fundamentally trying to solve that underlying problem of you cannot trust pure email, you cannot trust pure SMS. If you do not know how to communicate with somebody in advance, and especially in the mortgage space, that can be incredibly difficult, right? You have wire transfers going out every day, right? You have investors coming in, you have loans going out. Securing those modes of communication, that's obviously for everybody been an issue now for decades. Now that we're scaling this, you have to assume the existence of fraud and try to work your way into trust. So that's the big challenge for knowledge workers, right, inside this space. The big challenge is not only how do we use it effectively, but how do we ensure that our people continue to train up, continue to grow, continue to develop their knowledge, so that we have valuable people at the top who can continue to make use of these technologies. And that's a challenge I'm going to put in front of all of you. If I were a lot smarter, I might be able to solve it. But at the end, no challenge of this sort is a technical challenge. It's a human challenge. And so it's not the techies, it's not Silicon Valley that'll fix this. It's everybody out here in the real world. So I'll hold there. Any questions?
We have a tremendously, compliance is everywhere in our credit unions, the lending space. And there is a lot of chatter about AI. People think, some think it's just ChatGPT. Others, will talk about it being task-based to help you as an assistant. When institutions like credit unions and banks decide that they want to put something in there to help them automate tasks for their salespeople, what would be the best or the best actions for them to take first to start a project like that?
That's a great question. So I'll start by throwing out a couple of risks around here. And they're risks that I think probably you're all familiar with to a certain degree from things like machine learning and analytic projects, which is especially in finance, because of the nature of the regulations, you can end up inadvertently violating your regulatory duties by putting a black box system in to make decisions, right? Because AI, just like machine learning, just like everything else, right, it reifies the data it's been given. And so this is especially what areas like redlining, right? You're reifying things that regulatory we're attempting to correct, but you can end up amplifying through them. So that's the first thing. This is very true in healthcare. This is very true in this. Because you amplify the data that's fed into it, if that data is incorrect or invalid or undesirable, then you're going to potentially get into trouble. So the first
really simple. How many of you, by a show of hands, could use more members to give more mortgages to? Okay, all right, I think I'm in the right place. Well, again, my goal today, guys, share a little bit about me, who I am, but most importantly, talk about today's borrowers and how you can serve them. So, having said that, you're going to hear me say something called multicultural. And multicultural has a lot of different meanings to a lot of different people. At NAMBA, we focus on multicultural in really 4 cohorts. Single females, which I'm going to talk about a little bit here in just a second. Millennials, either all of us have one or know one or 2. Communities of color, Asian, Latino, African American, Native American, etc., and then LGBTQ. Those 4 cohorts, single females, millennials, communities of color, LGBTQ, are going to represent a significant amount of business opportunities. Matter of fact, I like to say it's almost a $2.9 trillion market. For any credit union across the country, in any MSA, in any day across America, I can literally show you and guarantee you that your untapped market consists of either 1, 2, 3, or 4 of the cohorts that I talked about. You can go deep in 1, you can go deep in 2, you can go deep in all 3, or conversely all 4. But in order to do that, you're going to have to first get to them. From a marketing standpoint, it's really simple. You've got to pivot from generic marketing to what we call intentional personalization from a marketing side. Why? Because your customer of yesterday is not your customer of today. Most of your customers of yesterday, they already have a mortgage. Are we correct? And there's probably a low likelihood of them wanting to get out of that mortgage anytime soon. However, your customer of tomorrow and your customer of today, they don't have a mortgage. So this number here, 23,721, ready today with a 720 or above FICO score in the great state of Oklahoma, who currently rent or do not own a home. 23,721. That is a huge opportunity to add new members, which, by the way, according to the last report that I read, the average member of a credit union is 53 years old. These individuals are not 53 years old. So when you think about building a customer for life with that new member, you have 23,721 opportunities with a 720 plus. So that number will actually double if we go down to 680 to 720. Already today, or either renting and or don't have a mortgage payment. Huge opportunity. So, ours are millennial, but they want to buy a home before they get married. Why? It's real simple. Take our first cohort, single females. According to NACE, National Association of College Educators, in 2023, the ratio of women to men entering college is 3-to-1. Now in 22 and 23, it was 2-to-1. But for 24 to 25 year-end academic year, it moved to 3-to-1, meaning for every 3 females enrolling at the University of Oklahoma, or Oklahoma State, or any other local college or public institution, is 3-to-1. As though if you're a community credit union and you're looking for a segment of potential members that you can engage and connect with, they're right there sitting in each of your local communities within a college or institution. 3-to-1. Those same females who are enrolling in Oklahoma today, Oklahoma State, or any other community, public, private college, they're coming out with high-paying jobs, high-paying degrees. But again, they're wanting to buy a home. They just don't know the journey. And most importantly, they don't know who to trust. In my opinion, credit unions are the institution of trust because you're built on the foundation of educating the communities that you live in. And to me, this is where credit unions have the advantage over banks and certainly IMBs, independent mortgage banks. You have always focused on educating members in your local markets. So what do we need to do, Tony, to make sure we get our member of today and our member of tomorrow? It's really simple. First, you got to listen and gather data to understand how your market looks. I just gave you some data. 21,721 people in our market have a 720 or higher credit scores. We can get the rest of those numbers. We can break it down by counties. We can break it down by MSAs, wherever your footprint is. The second piece is, what does that data look like in terms of the opportunity? Women, single females, millennials, communities of color, LGBTQ, so that we can then size up our marketing strategy, our outreach strategy, our LO strategy to support those markets. Where we have gaps, we then try to fill in those gaps. Number 2, get out of your comfort zone. You know, most people, when they hear about me and I get introduced, they say, it's Tony Thompson, he's the founder and CEO of the National Association of Minority Mortgage Bankers of America. But when they really get to know me, anybody will tell you, hey, I play chess, I play pickleball, I play golf, I can't jump, I'm a white dude. But most people, it's okay, you can laugh, but it's get out of your comfort zone. Because today's members, they just want you to be real. They want to connect, and they want to feel you being authentic. Number 3, focus on your audience perception of your brand. Credit unions do great things in the community each and every day. I go to each one of your websites, I can see the community give back, I can see your input, I can see the love you have for your community. But let me help you out. It's not about what you think you do. It's not about how you think you do it. It's about what they think. Because they're the client. They're the potential member. So we have to build our engagement strategy, making sure that we look through our potential members' eyes and not through our eyes. It's one of the biggest challenges that whether you're a credit union, a bank, an independent mortgage bank,
Now, I'm going to say this probably more than once. We often talk about generational wealth. Tony mentioned it. I hear it all the time whenever I go to credit union events. Generational wealth. It's an important topic. how do we focus on generational wealth and building that generational wealth for our membership? Well, if you're not part of every single life event that they go through, you're not going to be there for that generational wealth. And life events can be the big five. They can be something as simple as birthdays, anniversary of the loan.
Well, I had a question.
Yes.
So, and this might just be my ignorance, but if let's say in a banking app, right? So if I have a credit union app and I'm doing all my banking through the credit union, is there do you guys ever like kind of peep in and go, hey, your mortgage is this? Are you happy where you live? Does that happen a lot? Or I don't. I'm just trying to understand that better.
So I think that's a very good question. It's not as easy to answer as one may think,
Okay.
right? Oftentimes, our deposit mobile app, and I think that's the best way of saying it, your standard mobile app isn't integrated with the LOS, servicing system, something, right? It tends to be standalone.
Okay.
So from a member experience or life journey, systematically we're not integrated.
Okay. Because you have a lot of data on that person.
We have everything.
Yeah.
We know when they're divorced. We know when they have kids. We know when they graduate college. You name it, we are stalkers. But we don't stalk.
We measure it, but we don't act upon it.
Thank you.
Yeah.
We measure it, but we don't act upon it. So we're not really stalkers. We're kind of just like weird people.
Okay.
Okay?
Okay.
But there's a second part to that. The second part is the training of your branch, the branch staff. Those are verbal cues that should immediately hit the branch staff and say, okay, let me refer you to a loan officer. Let me refer you to someone in my mortgage division who might be able to help you with this financial.
Done better.
So your your loan officers are assigned branches. They go out and they build those relationships, but it can be done better.
Sure.
Once a month trainings,
Yeah.
once a month sit downs with branches to say, hey, this is the latest promotion we're having with mortgage. Let them feel a part of it, right? If they feel a part of the process, they're more likely going to engage with you.
We feed them and we create contests for them. So
Right.
if they sent so many referrals over that month, India has a budget to, give something away or do something and to try to promote that.
I think that one of the things that as credit unions we do is we overvalue the member relationship. I think that and when I say that, what I'm saying is that we think that they're a member of our institution, so they're going to come to us.
You're right.
We don't have to come.
That's
we
an
don't
assumption.
Go to them,
What happens when you assume?
Because
That's correct.
when they need something, they're going to ask. They're
That's
going to come to us. And I think that what we don't do enough, and I like the way you talked about, we look at the data, we don't act on the data. Okay, you have members who are turning certain ages. You can find out that data. And what does that call look like from an MLO? You have women, one of the markets that Tony talked about was the young females coming out of college. That age group. You have this many members who have maybe been members at your institution since they were little kids, right? And they've made that shift. Isn't it a good time when they turn 22 to have some sort of just a one-on-one call from them, to them, to talk to them about, what's next in your life? Where are you at in your life? And really encourage that relationship instead of just saying, oh, well, they've always had their checking account with us. They're gonna come to us when they need a mortgage. And I think that's why one of the reasons why we suffer is that we aren't as proactive because we take that for granted.
I think one of the things we've done is incorporate some of the technology.
Or repeating the things that we continue to do day in and day out. And so today, and on our agenda for this presentation, we're really going to focus on these 4 bullets. We're going to review whether or not we are stuck in the past or building for the future. We're going to focus on the market reality, costs, cycle times, member expectations, and then we're going to have some interaction where we focus on 4 growth shifts for us to win now. And then at the end, I'm going to provide you with 12 actions that you really can take back to your credit union and implement on Monday. So let's focus on, the simple truth and ask yourself a question. Are you a relic of the past or are you building for the future? And I think that is a simple question that all of us really need to ask ourselves, our teams, our credit unions, because again, I hear it all too often, well, we've always done it this way. Right? That is the kiss of death. I think we all know that. Because our industry, and as Tony already just showed us, it's changing, it's evolving, but we have not evolved. I often say this, that when you look at technology with other industries, the mortgage industry tends to be 5 steps behind healthcare or some other type of industry. But then when you look at credit unions, we tend to be about 5 steps behind every other person in the mortgage industry. And so that idea of, well, we've always done it this way, is what's leading us to not move the needle forward. Now on the screen, there's 3 metrics. One is 12.5 thousand, or $12,500. That is the average cost per loan, according to the MBA. So if you think about it, in order for you to originate one loan, and you factor in overhead, technology, staff, and salaries, you're spending about $12,500 at any given point in time. Now, that's just the industry average. I've talked to some credit unions whose cost per loans are as low as $6,000. I've also talked to some credit unions whose cost per loans were $23,000. That is ridiculous. Now, it's skewed a little bit. The rising cost for technology has kind of pushed this up. The changes that happened really during the pandemic with regards to LO comp has really pushed this up, but it's not going down. It will never go down. 2019, the average cost per loan, so right before the pandemic, the average cost per loan was $9,600. So in a short 5 years, it's increased significantly.
That's inflation.
That is inflation. And prior to 2019, if you look at 2010, keep in mind, the Great Recession, or the financial crisis, the average cost per loan was $5,200. Things are not going to get cheaper. 6.3. If you think about it, the average interest rate, when you look at every single fixed rate that we put out there, that is the average interest rate for a 30-year fix in 2025. But we often hear interest rates are too high. We blame rates for everything. I'm sorry, 6.3 is not bad. If that's the average we see, 6.3 is not bad. So we have to shift. We have to make that shift. And finally, that last point, less than 5%, that is the average capture rate that the credit union has of the total membership. So when you look at your entire membership at your credit union, less than 5% of them have a mortgage with you. Now, an argument could be made that we don't really know what that number should be. Should it be 20%? Should it be 50%? All I know is it should not be 5%. And by the way, 5% is being generous. I've seen credit unions who have capture rates of 2%, which at that point in time, they're not even marketing to their membership. So.
Because we take that for granted.
I think one of the things we've done is incorporate some of the technology. Now, we're still in the people business. We don't let technology do our job. You still got to pick up the phone, you still have to talk to people, but you got to stay in front of them. So we're using some of the technology that, so we have 77,000 members, you know, 20% of those have mortgages with us. But look at the other number, and so we have, you know, the value, as he had done, to send a value to your member and to bring them a value every month with the NDO that's in that market. And then now we began to do that by identifying all the members that have mortgages that don't have mortgages with us. And we'll begin to do that same kind of activation, stay in front of them and build that out to where, you know, I don't know how many times I've heard, I've been with the credit union for a long, long time, but for the first 20 years, it's like, oh, you guys do mortgages. And that's very painful for somebody that's been there for that to hear somebody say
Everybody
that.
does.
And so now we're trying to create we're dripping that out, and we're making, even though, you know, your marketing can send out stuff all day long, but if you're not targeting that with the MDO and trying to connect that relationship, as you say, then you're just sitting on a piece of paper.
Well, so, you know, it's, the idea behind connecting, you know, the relationship, but also the reach out, you know, that's the most important component, right? That constant reach out, staying in front of them, that helps build the relationship, right? You know, we can automate it all day long,
Yeah.
but it's the actions that actually require a loan officer to do it, or
Yes.
someone to do it. You know, for me, you know, I on the screen, I put the arm reset as a good example. How many of you are actually looking at your arms, and you'll say 6 months before the first recast, are reaching out to those members and saying, hey, it's time for you to refi? Who's doing that? Who's done that? Anyone? I mean, Bill has. Bill has. But you're doing it. So, but that is such an easy thing that actually, believe it or not, yes, financially, it works out for the credit union. But two, you could play it off as though you are the advocate for the member. Simple scripting. That's all it takes. Hey, you know, remember a couple years ago I put you in that arm. Really do appreciate, you know, you staying with us. But hey, now's that time. I want to make sure that you are better prepared financially for the next step. Let's take a look at the numbers and see whether or not it's the right thing for you to refi or stay in this arm. And having that and coming across as their advocate, that right there, you're building loyalty. You are assuring that they come back to you once that arm does hit. And I will just say this, if you're not looking at your arms and the resets, someone else already is. There's enough public data out there, thanks to Hundo 2018, that everybody knows everything on everyone. So if you're not looking at it, someone else is. Any other thoughts on techniques we can use